only look at it in terms of Bitcoin price. I mean, the unit numbers are arbitrary. The decimal point could have been somewhere else. And instead, it's more of like, what is the network worth, right? So the fact that it's only like $1 trillion and change right now for market cap, I think is tiny compared to what it could be worth in 10, 20, 30 years. So the question is that I ask myself is there anything that would just derail this? What is the probability that something replaces it or breaks it or otherwise just it doesn't work? And if none of those things happen, then I think the network value is likely far north of here in 10, 20 plus years.
In this recent interview from Mr. M podcast with Lyn Alden, we dive into 3 key topics that are highly relevant to today's financial landscape. First, the evolving role of Bitcoin as a global store of value and how it fits into the broader economic system. Second, we explore how Federal Reserve rate cuts are affecting inflation and what that means for Bitcoin's potential as a hedge. Lastly, we discuss the rise of decentralized technologies and how they are reshaping finance and other industries. At the time of this discussion, Bitcoin is trading around $63,000, showing a 1% increase in the last 24 hours and a 16% increase.
For me, it's like a lot of people, it's multiple touch points, right? So, I mean, back in like literally 2010 or 2011, someone was like, hey, I'm mining this Bitcoin on my gaming computer, and I thought, hey, I have a gaming computer, maybe I should do it. And I never got around to it. And then, it has like another bull run in like say 2013, and I'm like, oh yeah, it's Bitcoin. Like maybe I should get some. And then I kind of look at the exchanges, and they're really like sketchy looking, and I'm like, I got to put more time into this. I'll figure it out later. And then I just kind of forget about it again. I'm focusing on like work and relationships and health, and it's just Bitcoin it never really kind of hit that threshold for me to actually put the right time into it. By 2017, I was running my investment research firm, and Bitcoin started to have this bull run again. So I was like, okay, this time I'm going to actually like dive into this. So I wrote about it, and I had a very favorable opinion of it. But my article came out in November 2017, and I was like, this has become very over-enthused. And so I was like, I'm not going to buy it, but it's fascinating. But then I made sure not to mistake, so that when we had this blow off top and then it crashed and it underperformed for years, I kept watching it this time. And so I entered during that bear market. I watched the kind of the block size war play out. I watched, all this other stuff. I kind of saw how Bitcoin behaved. And some of the really simple things that are like kind of stupid in hindsight are like seeing the price chart in logarithmic form, right? Because if you look at it in linear form, it always looks either like a bubble or like a dead bubble. It's never really like, it's not a normal price chart because its price movements were so crazy. So if you look at a price chart in 2013, it looked insane. If you look at it in 2017, it looks insane. But after that significant time, you look at the price in log form, you're like, okay, there's actually kind of a cycle here that it's going through. That's interesting. And so simple things like just making sure to follow it in a bear market, and just a couple like clicks is when I got in that whole kind of bear market period. I mean, I think it's all of it. I think it's money. I think it goes through different adoption periods over time, right? So one of the first things it was used for is a collectible. People liked it because it was the best way of solving something that people have been trying to solve for a while. And then one of the first practical use cases was medium of exchange for WikiLeaks. When basically when other payments are shut down, here's this thing that can still work, right? But then the medium of exchange usage kind of stalled, or at least didn't grow as fast as many people thought. And I would say that's a couple key reasons. One is not everybody has payments problems, right? I mean, and I don't really wake up every day and think I'm trying to pay for things and I'm having trouble doing so, right? In certain jurisdictions, people have those issues. Throughout much of the developed world, not really, unless we're talking about international payments. And then in addition, most governments make every Bitcoin transaction taxable. So you have this big accounting overhead if you want to use it like that. So that's not really where it's gravitated to for a while. And instead, the store of value property became pretty dominant, which is, okay, I want to hold this thing that they're not making more of, and that is getting better over time as programmers keep building new layers and applications and things for it. And I think, I mean, at the long run, both are useful. I think generally speaking, it doesn't become a commonly used medium of exchange until people already have pretty large cash balances in it. And probably then the volatility is lower, because if 10 times more people hold it, there's like less individual whales or leverage or offshore stuff that could just blow up and then, knock 10% overnight or 20% overnight or more. So I think as it becomes larger, more liquid, more people have these balances in it, they're more likely to want to use it. There's more people in a country that then petition their government to change the tax structure around it. Maybe you exclude the first, certain amount of transactions from being taxable or things like that, or you go full El Salvador and just make it legal tender. But I think countries are going to move at their own speed, and over time it can also be more and more of a common medium of exchange. So I think it goes through different eras over time, and both of its attributes are important. I still think that the total addressable market of good money is arguably the biggest or second biggest market out there, along with real estate, right? So, if you look at, there's 900 trillion in estimated assets in the world. And so we're like less than 1% for Bitcoin. Even gold at something like 20 trillion now is tiny compared to global assets. Some of the areas that are shockingly big are fiat currencies and bonds. I mean, they're hundreds of trillions of dollars of value. And I think a lot of that is better served in Bitcoin. And just people, it's obviously got high volatility, which keeps people out. It's got technological uncertainty. I mean, it's a 15, 16-year-old project. So, nation states don't put their $1 trillion sovereign wealth fund aggressively into it until maybe it's 30 years old and it's 10 times bigger, right? So I think, and the way that I've described this before is that it has to reach certain thresholds before it even becomes interesting to higher thresholds. So back when the market cap was like $1 billion and it was pretty illiquid and literally one wealthy person could just buy in that day and move the price, that's not interesting to sovereign wealth funds or BlackRock or billionaires, because it's too small and illiquid for them to even put a significant amount of their capital into it. But then when it starts to become bigger, and they can say, well, I can actually layer into this asset at a meaningful amount for me, and there's a I can be fairly certain that I'd be able to sell if I needed to, because the liquidity would be there. And then higher level, then even bigger pools of capital can say, hey, this is actually worthwhile being on our radar now.
As we just heard Lyn Alden break down the critical role that Bitcoin plays in protecting wealth against inflation. Now we move deeper into the conversation to understand how Federal Reserve cuts are impacting Bitcoin's performance in the broader economic landscape. Lyn also touches on the innovations in decentralized finance and the ways in which these technologies are beginning to challenge traditional financial systems. This section highlights how economic policies and technological advancements are intersecting.
Banks serve a purpose in different areas of life over time, right? And their roles has changed. In the earlier times, you'd have basically money changers or HODL networks, and so basically you'd have these kind of proto banks. And basically what banks do is they provide kind of abstraction, right? So if I want to send value to you or you want to send value to me, especially over long distances, how do we do it? Well, in kind of the older era, it was easier to transport and safer to transport notes that represent a certain amount of precious metal rather than the precious metal each time. And then especially once the telegraph became more and more ubiquitous in the later half of the 1800s, we could update ledgers, update value by going through these intermediaries. So people gravitate toward them because they were providing a service. They were basically an abstraction layer on top of the actual money. But then the problem is, and this is what I focus on in the book, is that the gap between transaction speeds, so all that banking layer, became really, really fast compared to the settlement speeds, the ability to actually send gold from New York to London or whatever, and it's settled now. And so basically, as that gap grew, as we entered the telecommunications age, the early stage of it, we had this whole kind of virtual network of money moving around, and it's just claims moving around for gold that rarely ever moves. And that's a recipe for corruption. It's a recipe for very intense fractional reserve systems. It's a recipe for all sorts of problems. And so even in the late 1800s in the UK, for example, the system was levered 20 to 1. And that was when it was still working fine. That was kind of the classical golden age, the gold standard era. And yet under the surface, it was already highly levered. The way that I generally describe it is that they served a purpose, but that they caused issues along the way. And the way I would describe it now is that, with Bitcoin, it basically replaces the need for a central bank. It's this kind of core settlement ledger that if it were to become significantly large, it doesn't mean it replaces it today, but it means that the underlying ability is there to replace something like a central bank. And then I would say that banks would still exist in some form, just on the periphery. They're more optional, right? So we had this kind of situation over time where banks were on the periphery. They would provide certain services. They were optional. Then they gravitated toward being the literal center of the system. Like a dollar is a liability of the Federal Reserve. That's what a dollar is. That's what fiat currencies are. Literally, banks are the center of money now. And I think that we can gravitate back toward, no, like banks are not at the center of the system. They just provide services at the periphery of the system for those that want them. And I think that's in long term, that's healthier. I think probably years or decades, but it depends on what you mean by collapse. I mean, I visit every year, and they go through periods of 30-40% inflation. They've never, in the kind of modern history, they've never gone through a hyperinflation. Do we define that as having collapsed? Their money supply averages something like 20% growth per year. It's still functional. People are using it. It's not something you want to save value in. It causes all sorts of issues, but it's there. And I think the U.S., the dollar goes through a very long period before it even gets to that stage, let alone if we were to define that stage as having collapsed. And I would define like Venezuela's currency as collapsed, but not Egypt's. And I would say that the U.S. has a lot of runway before it looks something like Egypt's currency. Basically, the variables at play here are the U.S. has growing debts and deficits, and we have a structural trade deficit, and that's all bad for the currency. And on the other side of that, it's got two really big things going for it that are related. One is it's the most liquid and valued currency in the world, so it's the most saleable good among fiat currencies in the world. And so it's what a lot of companies and governments denominate contracts in, provide international financing in, and when you exchange two currencies, 90% of the time, the way you do it is you exchange one for the dollar and then the dollar for the other one. That's where you get the most liquid markets, and so it's entrenched there. And then the other point of that is that the majority of international debts are denominated in dollars. So there's over 13 trillion in dollar-denominated debts, plus all sorts of like swaps and options and other layers on top of that. But just literally securities and loans, over 13 trillion, and all of that represents inflexible demand for dollars, right? So that's more than the monetary base of dollars. There's more dollars owed to international creditors by various countries and their corporations than dollars exist. So there's more demand than there are dollars, at least base dollars, and nearly as much as broad dollars. And so that's inflexible demand. And so I think that Gordian knot has a very long time to unravel, and I think it's a long process. I don't think anything stops this train anytime, in the next several years. I think basically you have parallel systems, right? So one is going through entropy, meaning it's getting less orderly over time, and it's kind of past its heyday, and now it's got all sorts of issues, but it's still got all those entrenched massive network effects. And then you have rising new technology, new ecosystems, new enthusiasm, and the technology is generally better than it was any given 5-year period ago. And so I think basically what you can do, depending on what level you're at, is just you can opt out, or at least you can have a foot in both worlds. You can say, I'll use the incumbent system for when I have to, and for kind of local, most people have a bank account and they use it, but I'm going to kind of take that side with a grain of salt because it's only going in one weakening direction, and I'm going to embrace this newer thing, which is Bitcoin, or in some countries also stable coins, but basically really the two applications of this technology that have had really good product market fit, and say I'm going to go into this world instead, and I'm going to store my value in something that isn't diluted by any sort of central entity. And I think and then if you're a corporation or a government, you can do similar. Generally speaking, the smaller the entity, the fewer decision makers, and the larger the entity, the more decision makers, with some exceptions. And you just kind of opt out, and you protect yourself. And I think there's a very long process of more and more people doing it. And then along the way, what we're doing is we're testing this new system. We're saying, how secure is it really? How robust is it really? What needs to be improved about it, either on, say, the base layer or the various layers that click on top of it and enhance it. How can we make this better and truly replace as many components as possible of the prior entropic system.
Lyn Alden's insights on Bitcoin's potential as a global reserve currency and its role in a rapidly changing financial system offer much to think about. We would love to hear your thoughts on a few key questions. Do you believe Bitcoin will take a central role in global finance? And how do you think the Federal Reserve's current actions will influence cryptocurrency adoption? Don't forget to like and subscribe to keep the bull run going.